Welcome back to the PNJ Group series on the FASB Conceptual Framework. Once an item is recognized, one question remains. At what amount? That is measurement, and it is less settled than you might expect. There is no single number that fits every asset and liability. Instead, US GAAP keeps a toolkit of measurement attributes, and each standard tells you which tool to reach for. In this section, we open that toolkit and then zoom in on the most demanding tool of all, fair value. Let's begin. By the end of this section, you will be able to identify the 5 measurement attributes in use under US GAAP and match them to the balances where each one applies. You will explain the 3-level fair value hierarchy from a SC 820 and why it exists. You will apply the principal market concept that anchors a fair value measurement, and you will define highest and best use for non-financial assets. Let's start with why there is more than one attribute at all. Here's something that surprises newcomers. There is no universal way to measure a balance. SFAC 5 identifies 5 different measurement attributes, all in active use, and no single one is applied across the board. Instead, specific standards prescribe the appropriate attribute for each situation. A principled, unified measurement framework is still an active FASB project, not a finished rule. Why does this matter? Because measurement is not automatic. Part of your job is knowing which attribute a given standard demands, and being able to explain why that attribute fits the economics of the item. Let's start with the cost-based attributes. Historical cost is the amount paid or the fair value of what you gave up at the moment of acquisition. Its great virtue is that it is stable and verifiable, which is why it anchors property, plant and equipment, most intangibles, and inventory at cost. The second is current replacement cost, the amount it would take to replace the asset today. This one shows up in limited inventory contexts, where it can approximate net realizable value. Cost attributes trade away timeliness for reliability. The number is solid, even if it ages. Now the value-based attributes, which look forward instead of backward. Fair value is the price to sell an asset or transfer a liability in an orderly transaction at the measurement date, defined by a SC 820. It is an exit price, and it drives trading securities, derivatives, and assets acquired in business combinations. Net realizable value, or NRV, is expected sales proceeds minus the costs of completion and disposal. You will see NRV in receivables net of allowance, inventory write-downs, and assets of discontinued operations. These attributes capture current economics at the cost of relying more on judgment. The 5th attribute is present value, the discounted value of future cash flows using an appropriate discount rate. This is the right tool whenever the timing of cash matters, because $1 years from now is worth less than $1 today. You will meet present value in long-term notes, in pension obligations under a SC 715, and in asset retirement obligations under a SC 410. The discount rate is doing heavy lifting here, so a small change in rate can move the number meaningfully. That sensitivity is exactly why these measurements draw extra scrutiny. When fair value is required, a SC 820 does not just say estimate it. It imposes a 3-level hierarchy ranked by how observable and reliable the inputs are. Level 1 is the gold standard quoted prices in active markets for identical assets, like a listed stock, and these must be used without adjustment. Level 2 uses other observable inputs, such as quoted prices for similar items or observable market data like yield curves. Level 3 relies on unobservable inputs, the entity's own assumptions about what market participants would assume. The lower you go, the more judgment and the more risk. Watch out for this one. Level 3 is where fair value measurement gets dangerous because the inputs cannot be observed in any market. Think private company equity, illiquid structured credit, intangibles in a business combination, or goodwill impairment. Because the assumptions are your own, the disclosure burden is heavy. You must prepare a reconciliation of opening to closing balances, disclose the valuation technique and key unobservable inputs, and document a sensitivity analysis. And at PNJ Group, every Level 3 measurement requires manager approval. The principle is simple. The less the market tells you, the more you must show your work. Fair value also depends on where you imagine selling. The answer is the principal market, the one with the greatest volume and activity for the asset. If there is no principal market, you use the most advantageous market, the one giving the highest net proceeds for an asset or the lowest net cost for a liability. Here's a subtle point people miss. Transaction costs are excluded from the fair value measurement itself, even though you consider them when identifying the most advantageous market. Fair value is the price in the market, not the price after you have paid to get there. One last idea, and it can be counterintuitive. For non-financial assets, fair value assumes the highest and best use, the use that maximizes the asset's value to market participants. The catch is that this may differ from how you actually use the asset. A plot of land you use for storage might be worth far more to the market as a development site, and fair value reflects that higher use. When the actual use differs from the highest and best use, you disclose that fact. Fair value asks what the market would pay, not what you happen to be doing with the asset. Let's pull it together. US GAAP uses 5 measurement attributes: historical cost, replacement cost, fair value, net realizable value, and present value, and each standard prescribes the one that fits. Fair value is an exit price defined by a SC 820, measured in the principal market, excluding transaction costs, and assuming highest and best use for non-financial assets. Its 3-level hierarchy ranks inputs by observability, and Level 3 demands robust documentation and manager approval. Next, we put all of this to work in real recognition scenarios. Thank you for completing this section on measurement and fair value.